So we looked at budgets over the last 24 years. So from the year 2000 to 2023. And we kind of looked at all the key major announcements that were made in those budgets. And we classified them into either positive, negative, or neutral from an investor perspective, depending on what was kind of announced in those budgets. And we had some interesting findings. For one, market reactions tend to be counter to what you would expect based on what is being announced or what was actually announced. And for example, in the year 2004, the first UPA budget was presented, and the finance minister abolished long-term capital gains taxes, which means any gains from holding equities or mutual funds over 12 months would be tax-free, which you would think would be a major positive. But the markets fell over 3% that day. Um, a month later, of course, the markets were then up again 9%. But the immediate reaction was very unintuitive to what was actually decided in the budget. The worst budget return happened in the year 2008, when or 2009 rather. The world was just about in the middle of the global financial crisis. There was essentially a recession everywhere. The government announced an incremental expenditure of almost 2 lakh crores in order to kind of counter the slowdown. But the market fell 5% on that day. The best budget day return happened in 2021, when nothing significant was really announced, except that the government announced plans for the LIC IPO and disinvestment in BPCL, Air India, and the Shipping Corporation of India. So nothing of significance, but the markets ended the day up some 4% on that day. We looked overall at the percentage of times that the market ended up or down soon after a budget, like on budget day, a month later, and a year later. And we found that typically, the median one-day return on budget day was fairly flat. It was just about minus 0.1%, with a significant range in some years, of course. 1 week, or rather, interestingly, 1 week prior to the budgets, the markets have been negative 63% of the time. And then 1 week after the budget is almost like a mirror image, where the markets have been up 63% of the time. So it's almost like investors are um, anxious going into the budget, and therefore there's a lot of people who are looking to exit or reduce their equity holdings. And then as soon as the event happens, people are then fine to again buy into the market, and it seems to go up a little bit. If you zoom out, though, over 1 year time frames, the long term return tends to be very much the same as the long term equity market return. So it's up roughly. The median return is roughly 12%, or 12 to 13% up 1 year after budgets, and which implies that over the long term, the budget, it's more than the budgets, is really the global macros and earnings growth of the publicly listed companies that really drives market returns, and not specifically what was announced in the budget per se. So overall, there's a lot of excitement leading up to budgets as to what is going to be announced, and therefore what sectors are going to be in favor and what sectors are going to lose out. And a lot of preemptive action seems to happen. But then uh, overall, medians indicate that the market behavior is roughly the same as pretty much any other time frame that you might consider, which means that if you're a long-term investor, you're just better off not taking significant equity allocation decisions, whether it is to reduce or to add or to change your exposure to different sectors, because the market reaction tends to be fairly counter to what you might expect based on what is being announced. So that is just something for equity investors to keep in mind. Some specific budget examples where the market behavior was very counterintuitive to what was actually discussed. So in 2001, for example, the finance minister announced a 10-year tax holiday for core infrastructure sectors like roads, waterways, irrigation. There was a 5-year tax holiday for the telecom sector, which was liberalizing at that time. Again, things that should have been largely positive for investors, but the market was down 16% in a month after that budget. Another example is the 2008 budget we talked about. There was a farmer loan waiver of 60,000 crores. Um, And to sort of finance some of that, there was an increase in the duty for crude oil. And STCG, or the short term capital gain tax, was increased to 15%. And the market was up 13% a month after that. In 2015, the finance minister announced a roadmap to reduce corporate tax rates down to 25% over a 4-year time frame. The market barely moved on that day, and a month later, the markets were 4% down. 2018, long-term capital gains taxes were reintroduced, which means gains of over 1 lakh in a year would be taxable. The market barely moved on that day. It was, I think, down about 0.1%. It was down about 5% a month later. So all of those examples, basically, what you would expect were huge positives for investors in general, didn't really result in significant positive movement, or what you would expect were negative for investors didn't really result in a lot of significant selling off of the market. So it's pretty hard to, even if you're right in predicting what's going to come out in the budget, it's pretty hard to actually predict the direction that the markets are going to take, at least in the short term. And in the long term, of course, those announcements don't seem to matter as much. It's really what happens to corporate earnings over the long term that seem to matter. The media is going to hotly discuss what's going to come up in the budget and what's likely to happen and what sectors are likely to get favored and what sectors are going to see negative steps, whether there's going to be uh, additional taxes or not, whether direct or indirect. A lot of speculation around that, and every time a rumor comes out, there's going to be a reaction in the market. But essentially, what we've learned from looking at the last 24 years of market data is that you can't. It's unlikely that you're going to get it right in terms of trying to figure out what the market is going to do, and over the longer term, it doesn't seem to matter as well. So the question really is, should you be paying that much attention to what's being discussed, especially as anticipation to the budget announcements? My take would be to just stay invested and just stick with what your long-term investment plan is, and not do too many decisions around either reducing or increasing allocation based on what you think is going to happen.